All right, in this lesson, we're going to look at Treasury stock and what that is, but also what the journal entry would look like when a company reacquires their shares but doesn't retire them. And that's the key word. We're not retiring them. So we're going to need to do a journal entry to separate how much we own from an issued standpoint, how much we own from a treasury standpoint versus how much has been issued from an outstanding standpoint. So let's take a look at treasury stock. So treasury stock are stocks that a company has issued but has repurchased them. Now, why does companies repurchase them? Well, some of the reasons why they would repurchase them include that it reduces the amount of shares that are outstanding, and therefore, if you reduce the supply of their shares in the market, it increases their price per share. So by doing that, it artificially increases that price. And if it increases that price, it looks like it's more expensive. Typically, this is often done when a company feels that their stock price is too low versus what it should be. And so one way of making it go up is to buy back their shares. When they buy back their shares, supply and demand laws come into place. And so because the supply is now smaller and the demand is still the same, the price basically artificially goes up. You often see this with companies who are in the penny stock or area. They may decide that they need to buy it so they can take it from a penny up to $1 or $2 or $3. And so that's one way they can definitely do that. The other reason is that they might use these shares for various corporate reasons. So they buy them, they have them as treasury stock, and they'll reissue them, but for a corporate reason. Some reasons include stock options for the employees. So employees might have a stock option plan where company will sell the stock to their employees at a fixed dollar. Well, in order to do that, the company is going to have inventory of stock available so that their employees can buy. So that's one reason, is to facilitate stock options. And the other one is maybe they are thinking about acquiring another company. Now, although when you acquire another company, usually you pay in cash. So like if I'm going to go buy, let's say Disney, the Walt Disney Company, I could buy it in all cash, but maybe a company doesn't have all cash, or maybe it's just not strategic to buy it in all cash because then they won't have cash to then help integrate both companies. And so what they might do as part of the deal is to offer some cash and also offer shares in their own company. So basically, shareholders of the new company become shareholders of the old company, which will then become the new combined company. So by doing that, we have to have shares to be able to facilitate those transactions. So a lot of times you will see corporate purchases, and it's either going to be part cash and part stock, or it's going to be all stock. So no cash exchange. Literally, it's we're going to issue 2 of our shares for every 1 share you have in this old company. And by doing that, you guys become the new shareholders of this bigger company, or something like that. Very rare do you see an all cash, unless, again, the markets show that it's better to use the cash rather than issue stock. And there are certain reasons why that would be better, but you'll usually see a stock issuance in order to purchase another company. And so you need treasury stock to be able to facilitate that transaction. So how do we report them or record them in our books? So let's use an example as a way to help us understand this. So company A repurchased 25,000 shares of their stock at $15 a share. So they literally go out, tell their brokers, I guess, to go buy 25,000 shares at $15 a share. The company's board of directors believed this was a great opportunity to repurchase their shares as they were priced way under what they believed they should be worth. Usually how it happens. Prepare the journal entry for the repurchasing of those shares. So first off, we need to know how much cash are we, the company, is going to have to pay to rebuy those shares. So we know it's going to be 25,000 shares at $15 a share, which would give us $375,000. So the company's going to need to come up with $375,000 in order to rebuy their shares. So we know that's going to be cash out. Cash out would be a credit. So we're going to credit cash in the amount of $375,000. And then we need to debit something. So what are we going to debit? Well, we are going to debit Treasury stock. So this is a new account for you, but it literally is Treasury stock. So we're going to debit Treasury stock in the amount of how much we paid, $375. Now, one thing to know is we're not going to touch common stock. We're also not going to touch additional paid-in capital. We're literally creating a new account. This will kind of offset those accounts. So it offsets the combined common shareholders and common shareholders or common stock and the additional paid-in capital associated. This offsets those two combined accounts by $375,000. So don't touch common stock. Don't touch APIC. Just debit Treasury stock for $375, credit cash for $375, and then we leave it alone until we sell it, which we'll get to in another lesson. So that's what our journal entry be for a buyback of stock for $15 a share of 25,000 shares of company A. So hope you enjoyed this lesson where we talk about treasury stock and help you understand how would we record treasury stock, why treasury stock is important for companies and why they may purchase them back and what reasons they would use them for. And we hope that I hope that you got the example and it makes it pretty simple at the end of the day. And until then, I hope you enjoyed this lesson and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.